Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, May 10, 2017, looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And as you can see, we had pretty much another quiet day today out here in the markets. The Spider was up just 28 cents or just over 0.1%. And if you look down here at the bottom right hand at the volume area on the screen, you'll see here that we've had very, very light volume over the last several trading sessions, and it's actually decreasing. Well, for the most part, it's decreasing volume over the last 3 sessions. And that generally says that there's just a lack of conviction one way or the other. Let's talk about the bigger picture, what my expectations are for the market over the near term, and then even the intermediate term. So what I think is going on here, and we're going to get to some reasons why when we get to the other markets, namely the IWM and the transports, but for the Spider, I still contend that we're going to get to the $240.50 area, maybe as high as $241. But at this particular point in time, on this run, I don't think the market has enough juice to get through that area. We're kind of grinding higher rather than going higher with institutional participation and conviction. Without the institutional conviction, it's unlikely we're going to make any major push to the upside. Now, I'm still not suggesting that that's the total upside to the market. I just think we're going to have some kind of another pullback or corrective pattern before that next leg begins, or potentially what will be the final leg before a more meaningful correction takes place. So all in all, the bigger picture, or at least on the short term, nothing's changed. Remember, you'll start to hear, if we do get any kind of a corrective pattern starting in the markets, you'll start to hear, and you should all remember from year after year after year, you hear the terms sell in May and go away. I don't necessarily think this is going to be a sell in May and go away scenario, only if we do start to see the market pull back. And by the way, I think we're going to reach those numbers this week. Whether it's tomorrow or into Friday, I think it's this week. That's the most likely scenario as far as I can tell. And if I'm right, then we may see a corrective situation begin over the next week or so following the reaching of 240.50 to 240, or 241, pardon me. And that's when you'll begin to hear the banter about sell in May and go away. I don't necessarily think that's the case. I think the market will trade up through June, maybe even into July at the latest. That's at the point in which we're going to be looking for the more meaningful correction to begin in this market into the second half of the year. Net, not much happened today. It's almost like we're into the summer months, also called the summer doldrums, where the market gets very quiet, trades very light volume, and there's not a lot of activity. However, I do think we're going to push higher, and let me just explain why I think that this isn't necessarily a pattern of strength right now. You see here, we go up and we pull back, and that sets up another leg in the market. Here's another corrective pattern, a pullback. That sets up energy for another higher move. Okay, even here, correction, a little pop, but then we had a more meaningful correction, and look where we are now. This is 70 or 80 handles from where we were in the low. So the pattern that we're experiencing right now, I like to call it more of a drift. So we're kind of drifting higher, and this is not a pattern of strength. The market is not building energy for another move higher on a drift higher. If we were pulling back like this, I would have a different outlook. We could then pop higher, but that's not what's going on, and that's one of the reasons, not the only reason, but it's playing into one of the reasons why I think the market's going to stall out. Just call it at 240, 241 top end right here, right now. One of the things we can be looking for, and I'm not suggesting this is going to happen, I really don't know, but it can happen. Tomorrow or Friday, for example, let's say we have a gap higher into the level 240.5, 241, somewhere in that neighborhood. If we have a gap higher and what's called a gap and crap, and we finish down on the lows, which would put in a reversal bar or a reversal candle on the daily chart, that'll be a signal that we're likely starting a multi-day, potentially even a couple of weeks worth of a corrective to sideways pattern. I don't think we have a ton of downside in the cards at this particular point in time. I just think that the market is going to run out of steam at the levels discussed. Let's go over to the IWM and we'll begin to discuss some of the things I'm seeing that leads me to this conclusion. So there's a little bit of unusual behavior occurring across the markets. We've seen some divergences between the IWM and the spiders and the NASDAQ and the transports, and they're not necessarily acting the way they should if this market was totally bullish. They should all be going up together. We've seen the IWM pull back, and today was an up day, certainly leading, well, I don't want to say leading the markets because the spider was only up a fraction, but certainly leading on the upside today, up over 0.5%. But we still have, the way I see it, a bearish pattern developing in the IWM. You have this down move and you have this bearish wedge going on here that will generally promote another down move. There's been a divergence between what the IWM chart looks like and the spider chart. If you look at the IWM, we had a down move and we're consolidating over the 20-period moving average, which is the red sloping trend line, in a bearish formation. If you just look at the spiders real quick, it's not even close. It's not the same at all. So the markets are diverging, and when we look at the transports, we'll see more evidence of that. But this is the reason why I believe that we're getting signals that the market, the overall market, meaning the S&P, is a little bit tired up at these levels. Other markets tend to give you signals. Yes, the IWM was up today, but I'm still looking at this bearish pattern and still looking at the fact that the IWM is off its highs and the S&P is trading, making newer highs, pardon me, not newer highs, but close to the highs, ready to make newer highs. And that's a divergence. And when markets diverge, it's a little bit what I like to call simply unusual behavior. And when we see unusual behavior, it's generally a signal of something coming. And the something I think is coming is somewhat of, and it's not a long-term, but a shorter-term corrective phase once again. And think about it. We've seen this many, many times. If you've been paying attention to the markets for any length of time, you've seen this hundreds or dozens of times, whatever the case is, where the spider will make a new high. It could be a stock, it could be anything, but here's where we are. Let's suggest that the S&P 500 makes a new high, and that'll get everybody excited. You'll have euphoria in the markets. They'll begin to talk about higher numbers on the upside, and that's just at the time when they'll generally open the trap door or pull the rug out, and you'll see another corrective phase begin. Again, I'm not looking for a big corrective phase right now, but that's typically what happens, and that's the market's way of sucking everybody in and then pulling the rug out and trying to fool as many people as possible as much of the time as possible. I think we're going to see something similar to that in the next couple of days. Here's some more evidence. When you go over and look at the transports are having trouble. Now we've closed below the 20-period moving average today. We were sandwiched in there, and we seem to be, I discussed it last night, there's a hint of a bearish pattern developing here, and until and unless, and this would promote more downside like this, until and unless we can close above the high of 92.1124, then this market has more downside coming. That's what happens. If the market can't close above that number, it's going in the other direction. It kind of checks a door on one side, meaning the upside. If that door is locked, it gets rejected and it's got to go find another door, and that door happens to be on the downside. So this is part of that divergence or unusual behavior I'm mentioning, where you see the spider creeping higher, you see the IWM making a bearish pattern. Yes, it was up today, but the transports were down. There's something going on underneath the hood of the markets that it's at least telling me that something else is amiss, or something is amiss, and we should err on the side of caution, even though I do think there's slightly higher prices coming in the S&P 500, but in the very near term. You know, I always use the analogy of puzzle pieces, putting them on the table and putting the pieces to the puzzle together, and that's what I'm doing, looking at all the various markets, and what the puzzle is telling me is the puzzle tells me that this market is running out of steam in the short term and likely to have a corrective phase over the next, let's say, week or two. That's what I see. We'll see how it plays out. We'll obviously discuss it each and every night, but that's what I think is going on underneath the hood of this market. Another piece of evidence, we can look at the broker-dealer index, which I also like to use as a leading or lagging indicator. And what you'll see here is the XBD is lagging the market, and we cannot get above this red candle high at 220. We've tried it, was rejected. We got as high as 219.98, and the market was rejected. Now, it could be putting in a bullish pattern for another push higher, but as it stands right now, unless and until we can get above and close above on a daily chart closing basis this red candle high, then this market is likely to get rejected to the downside. Again, not a tremendous move to the downside, but a corrective phase nonetheless. Let's go over to the gold market and talk about that for a minute. And what you'll see here is we're still trying to hold this 1220 level, give or take. And the actual number was 1221.30. We're below it now, but we're still trying to hold this level on the daily chart. As far as I'm concerned, anything below yesterday's low at about 1214 brings gold down in the 1200 area. But there is something that's interesting that I want to point out. And when you look at the GDX, and I know there's some traders out there that like the GDX, I'm not in love with this chart from a longer term perspective. However, what I am noticing is that GDX was up today while gold really didn't do much. It was up $2 or $3 today, gold was. However, the GDX was up 2% today, or 42 cents. Now, why is that important? Many times you'll find that the GDX acts as a leading indicator to gold. It will move on the upside or the downside a lot of time ahead of the metal itself. If this is in fact acting as a leading indicator right now, then the odds favor a small rally or potentially larger for the metal itself into whether it's tomorrow or Friday or beyond. We'll see. But I would look for a rally to ensue off the 1220 level in gold. So going back to the gold chart, if this level is going to hold, we'll likely get a pop higher, and you'll find resistance up at the 1241.70 level. We'll call it 1241, 1242 level. That will be a decent level of resistance, at least the first level of resistance for gold. After that, we'll find more resistance up at the 50 period moving average. We'll call it 1250 for a round number. We talked about these numbers last night. Everything remains the same. As long as we don't break yesterday's low, then the metal may move higher as indicated by GDX today. We'll see if that is in fact acting as a leading indicator. Now, we did see silver get off the mat today, had a nice little spike higher, backed off, still finished up short of 1%, but up nonetheless, and this has been down perpetually for 3 weeks. That's a big move. When something goes down 3 weeks in a row, you're generally getting close to an area where it should find some kind of support for at least an oversold bounce coming. And ironically enough, what you'll notice is, where did silver find a low? It found a low at 1606. The low of this green candle that was a breakout candle was 1607. 1 penny, and then we reversed off that level. So here's a green candle low, And after 3 weeks of downside activity in silver, we found some kind of at least short-term support. If gold begins to rally, then my expectation is we'll see the same in silver as well. Since we talked about GDX, let me bring it back up and I'll give you some upside targets if this thing should continue to rally on the upside. So the natural area of resistance is going to be right about the convergence of the moving averages coming in today at 2264. The other reason why that's going to be an interesting resistance point is you can see here you have some pivot lows. That's going to be a resistant point. So we'll call it 2250 to 2260 is going to be a resistance point. If we should push through that, then the next area of resistance is going to be in between $22.75 and $23. So there's not a ton of upside, at least from what I can tell, in the GDX. But if anybody is long or would like to be long GDX, those are the areas where I would certainly be taking a profit. Now, why do I say I don't love the chart of GDX? Well, first of all, we're below the moving averages on the daily chart. That's not a sign of strength in a chart. That's item number one. Item number two is you have lower highs. High, lower high, and you're struggling down here, okay? That's item number two. Item number three is when you look at the weekly chart, you're below the 20, below the 50-week moving average, and you're struggling at the 200-week moving average. And again, this is, it's the same lower highs. Okay, so here's a high, third lower high. Okay, so this is a problem as well. So you have a downtrending equity or instrument, if you will. And then when you even go to the monthly chart, you have a pattern inside of a pattern. And these are always tough customers to read because it can go in either direction. But here's the issue. From this green candle, it looks like we're making a bullish pattern that would likely go higher. But the only place this would really go is to the high of this red candle here that comes at 25.93. Now that's a nice move from where we are, and make no mistake about it. The problem is if this bearish pattern plays out from this red candle all the way from November of 2016, if this plays out, then it brings us back down to this double bottom down here at 18.5, maybe even slightly lower. And that's why I'm not in love with the GDX chart. This is not a chart showing strength. It's making lower highs and all the other reasons why I cited. It's just not something I'm interested in taking a long position in. I'm certainly not interested in shorting it. I just don't want to trade it because it's not giving me a good signal in one direction or another. And if I add up all the evidence is on the bear side. That's why. So hopefully that's helpful for those of you that like the GDX. Let's go over to crude. Big up day in crude today. And where did we go? We went to the high of 47.78. The number we said last night was 47.75, 3 cents, and backed off. So we have the 45.92. That looks to be a good low, at least for now. I think it'll hold for a while. If we can get above 47.75 on a daily chart closing basis, the next area is going to be around 49 to 49 and a quarter. It's not going to happen just like that. They're going to come back down and test 47, maybe even 46.75 before trying again to make another run higher. That's just the way the market works. In particular, crude oil, which is not easy to trade. Anybody that has traded or does trade in crude oil obviously knows that. However, this is going according to plan. Moving over into the bond market, a slight downtick today in the bond market. However, we are holding, at least for the time being, in this general area of 150.21. This was always going to be daily chart support, which is going to be good for at minimum of a couple of days, potentially more. It's a 50% retracement discussed last night from pivot low to pivot high. This was 50%. Markets do that all the time, and when they do, they'll generally find support in this area for at least a few days, if not more. If the bond market comes down further, you will see, or farther, you will see support right in this general area here. You can see all the chart support in this area, all the support in this area. This is chart vibration, consolidation. You'll find support there one more time. And why? A secondary reason is it will be in this area, a 618 retracement from pivot low to pivot high. Here's your 50% retrace. Your 618 is somewhere in this general zone where you have this additional chart support. That should provide support one more time for the bond market if we should come down farther. Looking over at the US dollar, also known as the Dixie, after two pretty sizable up days, we saw somewhat of a sideways day today in the dollar. We'll have to see what happens over the next couple of days, whether this goes sideways, which will be setting up sideways to lower, which would be setting up for another move higher, or is it rejected at this point and trades back down? I still contend the dollar has another move lower before finding final low. We'll be looking for signs of a reversal signal, an engulfing candle, some kind of a doji candle or a reversal candle. That's what we'll be looking for, but I'm looking for it down in the 97 area towards the lower end of this channel down here. Right now, we're closer to the middle end of the channel, but headed towards the top end. We'll see what happens. I don't think we break out at this point in time. I do think we still have lower to go in the dollar. Nothing's changed from my perspective. And with that tonight, it's everything I wanted to discuss, so we'll leave it there. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.